Hi, everybody. Thanks for tuning in to our video here. We're very lucky to be joined by Jivan Sanghera, a mortgage broker at Circle Mortgage. Myself, I'm Per Homer. I'm a wealth management advisor at Assante Wealth Management. Some of you may or may not know me. This is a fun disclaimer slide that we need to show prior to getting going. But Jivan is one of my trusted contacts, and he's helped me and my family with our mortgage recently. He helps a lot of our clients with their mortgages as well, and a lot of people I know as well through the Oakville and Burlington Dads groups. Jivan is very focused on doing what's best for you, the consumer. And what I find is great is he has access to a huge array of banks and lending institutions and tools to make sure that you get the best deal for you. And it's an interesting conversation we're going to have, because it's not always about, necessarily the cheapest rate. Sometimes it's about the best fit as well. So with that, we're going to go ahead with some questions. I've got 3 questions for you here, Jivan, if you're ready. Say hi to everybody. Jivan, so the first thing is, we're seeing the Bank of Canada recently raised interest rates 50 basis points. And we're seeing a lot of people coming to me and they're asking me, hey, Per, what should I do? Should I switch a lot of people saying I have a variable rate mortgage, or I'm renewing my mortgage, and should I switch to a fixed rate mortgage? And I say, well, if you're really strapped for cash and you're really tight, maybe, because then you know exactly what your payment is. But I know, Jivan, you have a perspective and some wisdom on this, and I was hoping you could share it. Fixed versus variable, what should we do?
Absolutely. First off, Per, thank you so much for the invitation to chat with your audience today. I've always enjoyed working with Assante Wealth. I think you guys are a very professional group, and it reflects great when we're working together, because people have a good understanding of what they can expect from both of us. As a matter of what's going on with interest rates and what's happening in the fixed or variable conversation, the one thing people need to recognize is that in taking a variable rate mortgage, you are indeed tying yourself to the market. As prime rises, your rate will go up. If prime falls, your rate will fall. In the fixed rate today, to give you an example, the 5-year fixed rate on average has now exceeded 4% for a 5-year term. The best variable that we have for people as of today, as of you and I having this conversation, on a 3.2% prime is as low as 2.25%.
Wow.
So when we take a look at that spread between those two rates, let's even just call it 4%, we're looking at a spread of 1.75%. In the traditional context of Bank of Canada moves, that would be up to 7 rate increases. Now, we saw something at the last Bank of Canada meeting in April that I don't think you or I would have witnessed in our lifetimes. And that was as an increase of 50 basis points, almost as like an emergency measure to try and bring inflation in control. You and I, both with economics backgrounds, also know that a lot of this inflation is actually commodity based. It's not necessarily a supply and demand scenario. It's more of supply side cost that's pushing these rates up to levels that our country hasn't seen in more than 30 years. So in a very roundabout way, what I'm trying to say is that by going with a variable rate mortgage, you still have the potential of that rate coming back down if we do end up in a recession. You would be in a much better position to talk about recessionary pressures. I do my share of reading on a daily basis to have a good idea of what I should be advising to my customers. As of today, I am still advising that my customers, in the majority of situations, transact using a variable rate mortgage. Per, the interest rate is only one factor on a mortgage. So right here, we know that we're already saving money on the interest. The thing is that when people are purchasing a home, Per, it's usually one of the happiest days of their lives. So they're willing to sign almost anything to get to that finish line. And banks know this. And that's why something called the interest rate differential exists, IRD penalties, because those exist in fixed rate contracts where the bank is able to use this fictitious discount they've given you and is able to use that fictitious discount as a calculation point to calculate your penalty. So what I tell people is that with a variable rate mortgage, while I cannot guarantee your interest rate, I can always guarantee your exit. And you have no idea of the value of that until you need to exit.
Right. And that, I mean, that turns out to be a really big number, because some people, let's say you've locked into a 5-year mortgage or 5-year term on your mortgage.
Yeah.
And then things happen, right? You get a new job, the house is too small because you suddenly had, octuplets, or, God forbid, a divorce or something worse happening, and you need to sell the house, right? And you may not be going to a new house. You may not be able to port your mortgage, which means take it with you. And so that means you got to pay the break penalty. And, for someone who's 1 year into a 5-year term, that is not a small amount. You're not talking about $2,000-$3,000 here. We're talking tens of thousands of dollars, right?
Tens of thousands, right?
Tens of thousands.
The thing is
and then if I have a variable rate mortgage and I break it, I got to pay 3 months of interest, right? Which is
going to be under fly a kite.
Right. Yeah, and it's going to be under $10,000, right?
Oh no! On average, you're looking at 1.5 months payment.
Yeah.
Right. When you're comparing that to potentially 2% per year for each year remaining, for the example that you just gave, in a 2% IRD scenario, you're looking at, on a $500,000 mortgage, a penalty of $10K per year for each year remaining, versus being out of that mortgage for under $4,000. So again, when you start to compare, life happens in an instant, right? And more than 4 out of 10 Canadians ends up having to break their mortgage before their 5-year term is complete. If 40% of the market is going through this sort of experience, for me, it's something that should be legislated, right? Where if a penalty was a result of an actual loss and you could verify and show that loss, like the lender's loss of interest, that's really what they're basing this IRD stuff around. Saying we're not able to earn the yield that you agreed to give us, so that's why you owe us this 50 grand. And you go back and you look and you're like, holy cow, I didn't pay 50 grand in interest the whole time, depending on your interest rate. So when we're looking at what an institution is doing for us, again, if a penalty was 3 months interest across the board, which I feel it should be for all mortgage products, then the fixed versus variable is a very different conversation, because now you're not just talking about exit strategy, but you're also talking about the hedging side of things. But the challenge is that when you weigh the hedge versus the exit strategy wins 100% of the time. Yeah. So that's where, as a professional, I find it very important to encourage my customers to consider a variable rate mortgage because of that flexibility. And yes, the ride up is never fun. No. But what we're looking at is, what is our average cost over this 5-year period? And truth be told, you actually would qualify for more using a variable rate mortgage today than you would a fixed. And that's because the Bank of Canada requires any contract to be at its contract rate plus 2% or 5.25% as their current Bank of Canada qualifying rate. So that's where people qualify. So even though you're paying your mortgage at 2.25% today, or 2.3%, we've qualified you on 5.2. So we've worked in almost 3% of buffer there. So while nobody enjoys the ride up because it does pinch our pocketbook, it should not push any of our customers to a point where they can technically no longer afford their mortgage.
But we were talking a little bit of the real estate market before I pressed record here. And, I always tell clients that, before you go in and you can start looking at houses, that's fun and it's great. But it's also a good time to start talking to your mortgage broker and start talking to a guy like Jivan and say, hey, how much can I afford? What's my budget? How much money do I have to go shopping with, right? And so usually what you're looking at is, then I, as a bit of a layperson on the mortgage side, would say, make sure you get a pre-approval from your lending institution. But Jeevan, you were telling me that we need to be really careful there, and obviously, yes, planning ahead is important. But you had some thoughts you wanted to share as well.
For sure. So, as a matter of pre-approval and pre-qualification, they're two different terms, the value of which right now is basically zero. And the reason is that with 5-year fixed rates climbing to where they are today, again, that Bank of Canada qualifying rate, if you're looking at a fixed rate, is 5.25%, or the 5-year fixed rate plus 2%. So if you're looking at a 5-year fixed rate today, that's a 4%, 399, then you add 2%, you're qualifying at 6%. So that number you had in your mind that you thought you were golden with is no longer the case, because you technically have to qualify at a rate higher than what you currently qualify at. What we do for our customers, pair, is something called situational analysis. And what it really is it's a lot more work for us, because what we do is when our customer is actually making an offer, we go through the minutia of that offer with them prior to its submission. So even though they haven't necessarily won the offer process, I won't call them bids, because it was never designed to be an auction, and that's what it really was for about the last 5 years. But before they decide to present an offer, we will actually go through the minutia of that particular property with them and make sure that it indeed will fit their life today and over their 5-year period.
Perfect. And what are you seeing in the market? I mean, it was really hot in the Canadian real estate market, and houses on my street in February and March are selling for some silly numbers, and even now it still feels really silly when I see things sell around here. But I mean, not that I can do anything with it. Like, where would I move to? But it's all right, I guess. What are you seeing now? And because obviously you're seeing people come through and looking for pre-approvals. So the real, that's where the real, I guess, the rubber hits the road, right? It's the real truth of the ticker tape. What are you seeing happening in the Canadian housing market right now?
For sure. So I can speak to local, to Burlington, local, Hamilton, GTA sort of stuff.
Sure. Great.
And I do apologize for that email tone that keeps going off in my background. I don't know how to turn it off. So
that's because you're popular. Don't worry.
That's yeah, we do.
I'll stop emailing you then.
That's it. Thanks, man. Yeah. But as a matter of what I'm seeing take place in the market, is a shift, right? And the shift has been present now for, we're at the end of May, realistically at about the start of April, end of March. We're looking at peak at this chart now. We're looking at end of Jan, beginning of Feb as peak market. Prices have pulled back from that point already significantly. And, anecdotally, the best example I could give you is actually one of something that happened on my street. There's a beautiful home, just slightly bigger than mine, that I always kind of had my eye on. And I had said to its owner, if you're ever thinking of selling, just do me the courtesy of talking to me first.
Yeah.
Gentleman talks to me, gives me a price that he would be willing to accept. It was too rich for my blood, because I know how this market works. And that person went on to list their home with a realtor, forget this, more than 20% below what he was telling me he would accept.
Right.
Right. So more than 20% below. So he had his own idea in his mind of what his home was worth and what he thought it should go for. The reality check of what he thought it would go for versus what it listed at is a 20% delta, a change of 20%. And then, other situations, again, I'm having top of market conversations, right? So Per, you would know from your own background in economics that in situations of market shift, the first properties to be affected are usually the most expensive ones. Where you see that much change. I saw another property in North Burlington, beautiful home, 4,000 square feet, gorgeous. And I'm just looking at these things, folks, by the way. I'm not necessarily at that price point, but 25% reduction in price since listing at the beginning of March.
Wow. Yeah.
So, what I say to people is that now it's, there was always a time where you would say you sell before you buy. Now more than ever, or not more than ever, but now compared to most recently where you buy before you sell, we are returning to that sort of ratio of where it would probably be most prudent for our customers to sell their home, understanding exactly what they have in their hands, and then buy. June 1st.
And I totally recommend that. I mean, Suzanne and I went through, we've obviously bought and sold a number of homes.
Yeah.
And one time did we buy before we sold, and it all worked out fine. And it was, but it was probably one of the more stressful times in our financial life. It was very, very stressful, and I would never, ever do that again. I would always sell, exactly what your budget is. Then this is how much money I have. You've talked to your mortgage broker, exactly what you can roll your mortgage over to the next house for. And with confidence, you can go in and just put in your best foot forward on the next house you want to buy.
And the big thing is
too stressful.
Right now we're looking at a market. June 1st is right around the corner.
Yeah.
So next Wednesday is the next Bank of Canada meeting. And we're expecting a prime rate increase of hopefully a quarter point. But some people are even pointing at another half point increase.
Yep. Yeah.
Once that flows through, all bets are off, right? Because people are already becoming averse in the market. It's a headline world, pair, right?
Mm-hmm.
Where in December, the headline was, get in before it's too late. You'll never catch this market. Blah, blah, right? And I remember even meeting with somebody in January who on the phone had told me that they were okay selling their home to me privately for $990,000, right? And we're talking like a semi in Mississauga that needed to be gutted. Yeah. And by the time I got there, a day later, she said she wanted 1.1.
Yeah.
And I said, okay, well, it was nice to meet you again.
Yeah. Right.
On my way. That house is not worth, it's no longer worth the 1.1 she was asking for sure. I'm not even sure if it's worth the 990 I was willing to pay.
Yeah.
And that's where, as a matter of speculation for people that are not getting into the market with the right fundamentals and are doing it on a speculation basis, you are in a situation right now where if you were to close a deal today, I'm not sure that the house would be worth the same 60 days from now. Realistically, does it matter? No, because if you can afford your mortgage payment, then it really shouldn't matter at all. You bought and sold in a certain market, or you bought in a certain market, and people shouldn't be looking for single year over year yields on their home ownership. If they look back and remember, we're a lot more used to an annual appreciation of 3 to 5% a year than we are 33% a year. And I for one am looking forward to a more regular appreciation, a more normal appreciation, because you can kind of plan your life a lot better that way, having an understanding that even though you're not in a position to buy today, 6 months, a year from now, you will be, and the train won't have run away from you. It might be
and having a more balanced market also, I worry. And I was worried, and I still worry about, my kids who are, at the start of their teens, and what they're going to do for a house 10, 15 years from now when they're ready to buy, right? How is that going to work? And how are their incomes going to allow them to buy something? And obviously, millennials and Gen Z are stressed about that too. The younger millennials and Gen Z are stressed about that as well. And with all due reason, right? Yeah.
Previously, kids were going to their parents for equity.
Yeah,
that was my down payment. Now, kids aren't necessarily going to their parents for down payment. They still are, but what they're really saying is, co-sign for me. I need another 100K in income on this application for us to be able to buy this $900,000 house. But what I always caution about those situations is that while you're helping them achieve their goal of getting into a house that they don't technically qualify for right now, remember, they didn't technically qualify for that house when you decided to co-sign for them. And because of that, you might be in a situation where you need to help them for a little longer than you expected to.
Yeah. So you need to go in with your eyes wide open and make sure that if you've got to cover the mortgage payments a few months a year, then that you're cool with that. So
exactly.
Yeah, no, it's an interesting time. I think a slightly more balanced market will be welcome. I'm not sure a crash is coming per se, but I think we can take some of the silliness and frothiness and have a more transparent and comfortable buying process where you have a little more time as well to look at the house and make sure that it's the house for you and your family, and that and maybe even doing an inspection. That'd be crazy, right? So
I wouldn't get too excited. No, I'm just
no,
kidding.
I know. But at least, get your ducks in order before you buy the house, and maybe have a chance to go through it once or twice, as opposed to just standing on the street corner and throwing a bag of money on it. So with that, listen, we wanted to keep it short and sweet. A lot of information there. Jivan, as always, you're a font of knowledge. I always appreciate chatting with you about these things. Leah will, after, edit in a little slide here for us that will show your and my contact information if anyone's trying to reach out to us. Absolutely. And it's Friday, it's the weekend. Everybody have a wonderful weekend. Jivan, thank you so much.
No problem.
Leah, thank you for organizing this. And thank you. Well, and until next time.
Absolutely. And Per, actually, before you end this recording, in closing, if you're thinking of a cottage last summer, this might be the summer to buy it.
Okay. There you go. Makes sense. That makes a lot of sense. All right, guys. Everybody have a great weekend. Thank you so much.